another stock analysis. Today we will be looking at Match Group, dating products like Hinge and Tinder. So I actually didn't know they were even owned by the same company. That's pretty interesting. But anyway, we're going to be getting into them today. I've never looked into them before, so this will be a genuine first look at the company. And yeah, if you're interested, make sure to subscribe and let's get into it. So getting into Match Group here, they have a whole bunch of different products. I don't really know what any of these are, but anyway, moving on. Not really any industry metrics other than just payers. Seems like it is steadily decreasing from 2024, so could be bad, but also average revenue per user, I'm sure, is doing fine. However, they don't have that available, which kind of sucks, but it's okay. Market cap 8.6 billion, 2.3% dividend yield, and $37 target price and a 14% long-term growth rate. So slightly below that target price right now at $33. So could be a little bit of a downside, but an upside. But anyway, let's keep moving on here. So we don't have much in terms of a growth summary, but what we do have is positive. So that is good. Biggest thing here is EPS growth, which hopefully we do see because that does wonders for valuations of a company and will definitely make them look a lot more attractive to higher prices, which could be really good. Other than that, let's keep moving on through the financials here and get into their income statement to start off the video. So looking in here, we are in quarters. Let's go to fiscal quarters so we can actually see what's going on. And looking into this, we could see a decent amount of stability is a word I would use for this, but it looks like we're not going to get too much out of the quarters. So let's go into the years and see what we're dealing with. So honestly, they have not seen the craziest amount of sales growth compared to what I would be expecting. They have gained about $1 billion in sales in 4-ish years, but also, is that really the best growth? Kind of, but at the same time, that's also pretty slow, especially for a company like this where I feel like they're on the smaller end. They're probably growing a lot more, but also having $3.5 billion in sales with an $8 billion market cap, that kind of ratio is pretty good. So we could be seeing them at a much higher valuation soon. And saying that, let's look at their chart. So they actually have a chart available here from 1993 onwards, which is kind of insane when I think about it. But overall, what we're going to look at is the past couple of years where they had a very large run up, kind of peaking in 2021 around $180 a share and then dropping, I don't know how many percent, to $33 a share now. And they've been in kind of a consolidation range for a while. We are seeing a lot of lower highs, which isn't great, but also not really any lower lows either. So it's not necessarily in a downtrend, at least over the past couple months, but it's also not in an uptrend either. So we'll have to see if there is a breakout here at some point. But overall, basically, their stock price has been suffering for about 3 or 4 years now. So getting back into it, net income looks good, although they haven't really improved it at all in 4 years. There's been a very slight improvement, but at the same time, their profitability is down a lot. So overall, not really anything too great there. Also, I'm not sure entirely why we have a chart that goes back 20 years or so. Well, actually, basically 30 years. But we only have data for the past 5 years. So if you know why, let me know. Honestly, I could probably just figure out with a Google search, but I don't really feel like it because we're already going into this. Other than that, total shares have increased slightly. However, they've also been decreasing for 2 years, which is good. But at the same time, they're not really seeing more profits or anything. So I don't know why they would repurchase their shares when they're not seeing increased profits. But either way, going into the balance sheet now, overall, I would say their income statement was okay. However, with a company like this, I would kind of hope to see more growth, but either way, it's all right. Looking at their balance sheet, they have seen a decent amount of asset growth in the same time. Over $1 billion added in assets, and not really much of that at all is cash, which is good. A lot of times when we see total assets explode, it's because a company took out a ton of debt and it's just cash, which is fine and it will help the company, but at the same time, it's not really anything actually physical helping the company. So immediately, I should say. But anyway, debt situation is okay. They have just under 4 billion in total debt. And actually it looks like they've been at this range for basically the past 5 years, just coming down slightly in 2024, which is definitely a positive sign. Hopefully they wipe out that debt and they can use that extra flexibility and leverage to kind of grow the company more. But overall, I would say there's just not a lot going on here in terms of growth, which I think you can definitely see when we look back at the chart and see they've kind of just been flat. They evened out right around their same valuation from 7 years ago now. And since then, they're kind of just moving sideways. So especially, I'm gonna switch back and forth one more time. With their relatively high dividend yield, I guess it's not super high, but 2% per year, that also weighing on the now much lower stock price isn't really great, especially when they're not growing a very crazy amount. But it looks like we're getting a little bit of a change here. So cash flows have been growing. You can see they had 800 million in 2020. They're at 930 million now. So that is kind of good, but at the same time, it's mostly not crazy growth for over 5 years. That's basically my theme of this video right now, is the growth has not been that crazy, which is really what investors are looking for recently. And that's kind of what I'm looking for as well. One thing I will say is that they have been repurchasing a lot of their stock. They repurchased a ton actually in the past 3 years. So that is always good. Free cash flow. This is honestly a very positive sign. Free cash flow is very positive and very consistent as well. The biggest thing with cash flows is consistency, and growth is obviously excellent, but really you want to see them be cash flow positive as much as possible and as consistent as possible. And seeing that here, that is a very good sign for the company. So let's move on to the ratios, and we're going to see decreased profitability here, which is kind of just what's been happening with them. So in 2020, they were at 71% gross margin. They're at just under 67% now, which of course is below their 5-year average. Same thing with operating margin, same thing with net margin, but actually their net margin used to be a lot higher at 22% in 2020. The only reason it looks close to this average is because they had an outlier year in 2021 where their net margin was much lower. But honestly, even still, their net margin is much lower than it used to be, especially compared to 2023 as well. And it looks like they had a bit of a rough time 2021, 2022 with their margins, but overall, they're just not really seeing improvement here, at least in my opinion. Again, if you do know some more specifics about the actual company and not just the financials, please let me know in the comments. I would love to learn more. It's just that for these videos, I just focus on financials for the most part. And then company specific things, I kind of like to learn from the subscribers just to see what's actually going on, what's happening. Moving on, debt to equity, they are kind of high here, but honestly, not really. And again, they do have, looks like, negative equity, which is why this is showing up as a massive negative number. But overall, they do have a lot of debt, almost $4 billion in debt. So that is something to always think about with the company, as it could affect their kind of flexibility and leverage in the future. But overall, I don't think it is too crazy an amount. I think it's very manageable. So anyway, on to the earnings, and let's see what they've been doing recently. So Looks like they just released earnings about 3 weeks ago, so this is fairly new. So let's get into it and see what's going on here. Operating metrics, we have a lot to go through here. So first of all, revenue as a whole beat, which is good. Gross margin came in above as well. Operating margin came in a little bit below, and also year over year came in significantly below, about 4% lower. Payers decreased quarter over quarter, which isn't great, but that's just kind of how it happens. What I will say is that revenue per payer, though, did increase very slightly quarter over quarter, which sounds good. But honestly, when you compare it to a 4% drop in total payers, that doesn't really cancel out. So overall, I would say negative report here. Let's see if there's anything else. So announces some things. Let's see if this is the... Okay, so this is a little bit more. And we do have guidance here as well. So guidance came in below estimates. Operating income came in below. Revenue came in, I would say, also below. It does very slightly get the upper range of it, but it is still below. Operating income margin of at least 36%. Let's see what it is now, because I already forgot. Operating margin at 36% kind of seems unattainable, especially considering it's at 23% for 2024. If that does happen, that'd be pretty good, but overall, I'm not really sure if it will. CapEx, whatever, free cash flow. Overall, using at least 75% of free cash flow for share repurchases and target returning at least 100% of free cash flow to shareholders and share repurchases. That's crazy. Reduction of diluted shares outstanding by 5 to 7% over the next year. So these two things on the bottom are excellent. This is fantastic. The other things here are not great. Share repurchases, awesome. 5 to 7% of their shares being repurchased basically is 5 to 7% less supply of their stock that people can buy, which is great for investors. Overall, that's fantastic. Also, using their free cash flow almost entirely for repurchases and dividends is, again, fantastic. I love that. That's very good. The rest of this, though, is pretty bad. Lowering guidance is not really good. Also, quarter one guidance for 2025, significantly below estimates. Revenue is also significantly below, and operating income margin of 32%. That would be great if it happens, but overall, we won't know until their next report, which let's see when that is. Next report is in, come on, May 6th. So that is their quarter one 2025 report date. If they can meet those estimates with those margins, I think we could see this stock grow a lot. I would say the most important part about those is the margins. If they fall short of those, it's not going to be good. I feel like that kind of improvement just from fiscal year 2024 to quarter one 2025 is going to be pretty rough. But if it does happen, that's great. That's awesome. But we'll have to see. So other than that, let's try to do a valuation here and see what we can come up with. So I don't know what kind of named competitors they're really going to have. And yeah, they have Grindr and Meta. So interesting interesting setup here. They are undervalued compared to Meta, but unfortunately Grindr doesn't have a PE, so that's rough. Let's keep going through here and see if we can find a couple more customers or competitors, I should say. And there's a couple there, not really. Let's see. Sorry about the loading screens, but I'm just trying to find the best possible data here. And it looks like we have a couple more just in consumer data and services. So there are a lot here. However, there are also a lot of outliers here. But overall, compared to all of these companies, I would say that Match is relatively undervalued. So I'm not going to do the actual valuation part here where I go into my thing and go through everything, because there's really, like, these companies aren't really close to them at all. Like Zillow is buying homes, and Car Gurus is obviously cars. So like I feel like it wouldn't be very accurate, and their named competitors, the only PE we have available is Meta. So I'm going to say undervalued compared to what I've seen, but also their growth hasn't been great. I think Q1 2025 is going to be incredibly important, and we will see that on May 6th. So definitely something to watch out for. Other than that, that's all I have for Match today. Hope you enjoyed. Hope you learned something. Make sure to subscribe if you haven't. And I'll see everybody in the next video.